Well, welcome. So we have another episode of the Compaytence Academy slash podcast slash YouTube, and today we're getting to a topic that's a hot button for pretty much every online seller out there, and this is how to prevent funding holds and just questions around reserve recovery or how to unlock your accounts. Really, just best practices that we've pulled that from customers that have asked us questions around this over the years. And so today we brought in one of our legal partners who we work almost on a daily, if not weekly basis with here on recovering funds and on unlocking accounts with customers. But Isidoro, welcome. I know you're tuning in, I think from Italy, right? Are you back at
Yeah.
home today?
Italy, Naples today.
Awesome. Awesome. Rough life. I
Absolutely.
know you're traveling the globe. So glad to have you on. And then we have Natasha, who's one of our account executives here at Competence, also handles partnerships. So she's going to be kind of our moderator here and spitballing questions back and forth between me and Isadora to give you guys all the insights that you need to sell successfully online and hopefully prevent any type of funding holds or issues with payment processors as you start to scale. So Natasha, thanks for hopping on to kind of moderate this for us.
Awesome. Thanks, guys. So I'm going to split this up in two questions, two that are going to be based more on the legal side, and then the last two that would be based more on the e-com product side. So Isadora, I'll start with you. From both a legal and payment standpoint, we see that funding holds can be like a black box for merchants. So can you start by defining the most common types of funding holds, and then compliance related or risk based, and what typically would trigger them?
Yeah, so basically, when it comes to a legal standpoint, there might be like a variety of factors to play. From my side, as e-commerce grows, I've seen lots of funny holds, but the majority might come from intellectual property violations, and that would be when it comes to copyright, trademarks, patent, and therefore, of course, when we deal with merchants that have no idea what actually a trademark might be or even a patent, therefore they just within the drop shipping industry and business model, they from time to time they do make mistakes, and of course then things might happen like a funny hold. Then they might ask why the funds might be on hold, and of course the answer might be that perhaps might be actually an intellectual property violation, and in that case it's no longer a funny hold anymore. Might be actually a serious case coming out of it, and of course the payment processor is actually obliged to hold the money until the dispute is actually handled and therefore resolved. Other than the IP, what we've seen in our experience addressing so far, I believe hundreds of cases, we have, of course, the issue with disputes, chargebacks, and this when, of course, the scaling when it's too frequent and too fast. It's all about trust when it comes to deal with payment processors or even banks. They don't know you, they don't know what you do, where you come from, so they do need to establish trust. And of course, when we happen to stumble upon companies like Stripe, PayPal, Airwallex, of course, we are speaking about the top three companies in the world. And when you are a merchant just starting your own business, it's crucial to have a KYB and KYC in place so that they know what you're doing. And of course, having automated systems to get to know the merchant, sometimes it might fail, and there comes the funny hold. And along with the scaling, because it's all a consequence, it's all like an entangled system in which they have to get to know you, and if they don't know you, they're not going to trust you. If they don't trust you, the funds are going to be on hold 100%. And when I mean 100%, it's going to be like the entirety of your funds, even though perhaps Michael knows best. It takes to run a a risk assessment to calculate the financial exposure of your account. Sometimes they hold the funds 100%, but even though your financial exposure is not exposed 100%, so perhaps they might even need like 20% on hold by leaving the 80, and whereas they hold 100%. So it might be a variety of factors to play. Sometimes it might even be random. Of course, they have like a I don't know how to count them, but maybe Michael, you know best the merchant that they have. But of course, it cannot be only human powered when it comes to review the account. So it's the AI that must review the account. So it might happen that perhaps the artificial intelligence might fail one review and the accounts might be on hold. And that is actually maybe the funniest hold that I've ever seen, which it's not easy to overturn, as it takes, of course, expertise to tell and explain the payment processor that it was actually a funny hold in the first place. And it's very easy to have it restrained. It's very complicated to unblock it, merchants would say. So, and that's actually just the surface when scratching the issue. Of course, going deeper, we might actually run into hundreds of issues that might actually result in a hold. But of course, the most common ones might be the ones I listed before, and therefore this might be actually a quick overview of how merchants might get in troubles and lose access to the cash flow.
Yeah, absolutely. No, that's really great insight. And your law firm is global, and so with that, in our experience, platforms, or when we see platform terms like reserves or permanent holds, these are interpreted differently depending on where entities are based.
Yeah.
So you speak with guys who are in the U.S., EU, probably the Middle East. So often we also help merchants challenge these reserves with our targeted documentations, like a risk assessment, which you support. But when we're looking at the legal grounds for holds, what would you say is really the rights that the merchants legally have when it comes to withheld funds? Because there are global differences that we see. So, for example, again, between the U.S. and the EU. So, what rights do merchants actually have to
Well,
get their funds back?
yeah, of course, it's not always easy to actually interpret those terms. So, of course, um, payment processors have companies in each region of reference, might be the United States, Europe, Middle East, Australia. So, of course, the laws might differ and change, and in that case, the rights would be different, especially when it comes to consumer protection. That might alter the connection between the hold and the merchant, because it's all about trying to protect the consumers eventually. Of course, the terms would change. Let's just take as an example PayPal. PayPal has a company in the United States, European, Luxembourg in the UK after Brexit, and Hong Kong too. I'm lucky to be backed up by a team of professionals in each continent, of course, and to get them through. It's not easy because, of course, dealing with a hold in the United States might be completely different from taking on a case in Hong Kong, as the jurisdiction would be different, but also the leverage. Sometimes the US might be friendly compared to Hong Kong, whereas might be the opposite when dealing with Stripe in Hong Kong and maybe PayPal in Europe. So it's always a case-by-case scenario. That's why getting a merchant saying, I've got my funds on hold, please fix it, it's not actually very easy, as we need to look into the complexities of the case, where the company was incorporated, where they even sell, because the target is also important, because that applies, and actually changes the consumer protection, as the European Union has regulation, whereas the United States has others. It's always different, and of course we have to look at the package of laws under the perspective of the jurisdiction that we need to look into. Therefore, it's not easy and it's very challenging, but we are focused on making this very easy for merchants. I used to say to clients that, of course, what we do is not 100% accurate. Or I can't give the certainty of overturning the case, but of course we do our very best to mitigate and minimize the chances of even going to court, trying to get a deal both for the merchant but also for the payment processor. Because of course, when we engage with payment processor, we actually try to build a bridge between the merchant and the payment processor. Of course, sometimes we are successful, sometimes might be not, but it also depends on the merchant that we have and on the root of the problem. But of course, given that the industry is very complex and the jurisdictions are very entangled with each other, and I would say that it takes a very thorough analysis, both from a risk perspective, because of course the numbers might be the same when it comes to financial exposure. I mean, dispute rate might be the same in the United States and Europe, but the complexities of regulations that we can use will change whether we are in Germany, Italy, or the United States, or even Hong Kong. So it's a tailored legal protection that we offer to the merchants to help them and help you guys to make a bulletproof plan to get the money out.
Right. And that's really, really valuable service. And you had mentioned KYB earlier. And Mike, this is another area that we will assist on. So it's really important that these merchants, again, especially if they're global, they have KYB readiness. So Mike, for you, coming on the looking at it from an e-com perspective, when we're looking at KYC and KYB, re-verification, as you would say, so updating documents if they're going global, what would you say that you're seeing right now of the legal challenges merchants are facing when their KYB info is outdated? And then because
Yeah.
of this, their funds are being frozen and pending just those business documents.
Yeah. Yeah, I can speak more to the US side, I would say. I see this globally in the EU, UK, but like using the US as an example, there's really two legs of the pendulum, and I actually cover this in one of my courses on our academy, but you got to make sure that you have kind of a clean file when you submit everything into the likes of like Stripe or Shopify payments or PayPal. And so on the KYC side, there's personal identifiers. So you need to have a personal residence in the jurisdiction where you're setting up your account. So in the US, you need to have a US-based personal address. You need to have photo ID or documentation, government-issued photo ID. Now, if you're a foreigner, that can change, right? But typically, you can just upload a government-issued photo ID if you're a foreigner, and that'll suffice for the payment processing setup. And then the other piece is on the KYB side, so know your business side. So you need to have a business address, which is a physical address. So the mistake that a lot of sellers make, I'd say 90% of foreigners will come to me, and even sellers within the US, and just use a registered agent address. And a registered agent is just a representative that can file on your behalf and actually register your business. Typically this happens in Wyoming or Delaware, I believe in New Mexico as well. So there's certain states where you can use this service, but it doesn't constitute a actual address for your business. It's just where they're registering your business and an address for them. So you need to have a physical address. You can use a shared co-working space like a WeWork. I'm in a WeWork personally. It's just a place where there's literally hundreds of businesses and you have a desk in the facility. That'll work. The other piece, like a working phone number. So like having something where there's actual like validity behind the business. So once those checks are done, it usually doesn't lead to problems. So a lot of times once a seller onboards, and what I see is that they're missing one of those pieces of information, right? And then it trips something on Stripe's end. They're going to go manually review it, and then they're just asking more questions, basically. They're going to ask for supplier agreements. They're going to ask for forecasting models. It's like once one thing goes down, it kind of gives the need for that human being underwriter to kind of dig in a lot more to see exactly what potential issues could be. So if you look at fraud and look at fraud from like an outside scope, most online fraud happens when there's less information, right? Like fraudsters aren't providing or over providing information to banks or payment processors. So if you're emulating that behavior, they're going to put you in that bucket or that category. So you just have to make sure that you're providing information that's accurate, that's clean, complete, forecasting models, supplier agreements, like have everything ready to go. And you typically won't see an issue. You may get a stop or a question, but at least when you have a question, you're prepared. So that gives you a little bit more insights around that process.
Yeah, exactly. And you guys actually just both assisted with a large funding hold release. I think it was over $1 million. Was it on Stripe or Shopify?
I think one was actually it was Stripe and then PayPal. So $1 million on Stripe, I think. I think $1 million was on Stripe, Isidore, or close to. And then we had almost close to $1 million on PayPal.
Right. So that was a huge release. When we're looking at, so let's say a merchant currently has, 6 figures stuck in, or even $1 million in frozen funds. Then this next question will be for more of the legal and then the operational side. So Mike, you can talk on the operational. But what would you both say are the smartest first moves? So they have their KYB updated, their funds are now released. What's the smart first move after this that they can make legally and then operationally?
Well, legally, I always want to make sure that perhaps they haven't received any summons their way. So this is actually the first question I'll ask the clients. Usually in the e-commerce, it's 90% always an IP summons regarding trademarks, patents, and after that might be that maybe the client is too high risk to support. In that case, like this guy, the payment provider just held almost nearly $1 million as a fixed reserve just to cover their financial exposure in the long run. Because with payment processors, of course, it doesn't always happen that they just terminate the agreement and they place the funds on hold by default for 120 days or 180. They also let you keep processing with them, and they hold the money in reserve without giving you any release date unless you have actually some leverage to negotiate with them. But I believe, my experience when you deal with such companies, you don't have leverage, so they just unilaterally just impose their conditions, which you are supposed to just comply with. So if it's not the IP, it should be the financial exposure. In that case, we would need actually a forecast to be indicated and adjusted, so that we have to prove how it's going to be sustainable in the long run, up to at least 360 days, nearly a year, how the company can actually work with the payment provider without causing any harm to the payment provider in terms of disputes. So those would be the first two things that I could think of. But of course, when it's not IP, it might be it should be the financial exposure. Then it's a variety of factors, which would be the chain of fulfillment, the agreements that the company has with licensors. Of course, there should be like a distinction on whether it's a physical item or a digital item. Sometimes the physical items may have a stronger leverage depending on the quality. Well, instead, the digital service is different based on the subscriptions, because of course the subscriptions might be subject to a very rapid increase of disputes. So it depends, and also what comes into place also the jurisdiction, whether it's the United States, Europe, and I think that that third place was taken by Hong Kong merchants because of tax reasons that merchants go to Hong Kong to incorporate. And uh, the combination of those three factors must be taken very seriously, because one factor might actually backfire, and then you back to stage one, in which you have to come up with a plan on how to get the money out. In that case, that release was not easy because of a issue with the trust that the payment processor had towards that merchant. But sometimes when it comes to that amount of money, then you also need to put yourself in their shoes. The good way and the bad way. The good way is, what would you do if you were actually the risk officer? Would you actually release 1 million? And if you want to release 1 million, what would you want to have in return? In that case, I would want to have guarantees that they would actually be harmful in the long run. Sorry. And if I were actually a risk analyst and to be in my shoes, what would I think? Well, they will lose a lot of money if they lose a client that has 1 million on hold. And in that case, the processing fees that they would charge every month. So in that case, you need to find a deal with the payment provider to make sure that the merchant has access to the money, but also that the payment provider has their hands on the processing fees. Because at the end, it's not like they're giving you a favor to release the money. You're also working with them at some point, and they make money with you. And this is something that you do not have to forget. You have, of course, a set of regulations on your side being a merchant, but you never forget they make money with you, and they charge hefty fees, especially in high-risk industries. And in some circumstances, you have some leverage if you do some numbers in the long run. In that case, we were able to get an agreement with the payment provider, so that they would get their actually the fees that they actually had in mind to get all along, and the merchant was able to get the money to meet stakeholders' obligations, taxes, and anything that they had to do. So it's never easy, even though they Michael, and Natasha, they come to us and asking for an easy fix just to unblock. But it's never unblocking. It's mostly almost a wild negotiation with the payment provider to try to get the money out.
Right. Yeah, exactly. And then operationally, so Mike, when you were able to get those funds released, what would you say a merchant should be doing, especially if they're doing 500,000, a million monthly or more, and they have this amount of funds frozen, and then we get it released? What operationally could they be doing the next 30, 60 days, whether it's, a risk escalation contact or having reporting done? What would you say that they could do operationally to prevent this in the future?
Yeah, so we did a pretty thorough analysis on a couple different sites or funnels that they were running. You kind of want to look at the root cause issues. On this case, there's three things that they were kind of doing wrong, I would say. They were scaling way too fast. They opened new accounts, and then they went from like 100,000 to a million within like a 60-day time frame, right? With really no forecasting or projections brought into the provider, so the provider was very unaware of what was going on. The second piece was chargeback. So they implemented rapid dispute resolution, Ethica, CDRN, which are chargeback alert tools. So they were really relying on those to protect them from a chargeback perspective. But when that happens, your refund rates go up, because the chargeback alerts, you can set them to automatically refund, right? So then their refund rates spike. So whenever a business is less than 2 years in business and you have these kind of three different things happening, like, again, scaling too fast. Yes, they're using chargeback alerts, but chargeback alerts are a tool, but they're not a silver bullet, I would say. right? So
Right.
they're great to have, but if you're just relying on them to keep your dispute rate low, but your refund rate spikes, it's still almost the same in essence, I would say, because the providers look at risk exposure on both the refunds and chargebacks, right? So really taking a step back, and I've been almost working with them about 6-7 months now. We really kind of cooled things down and really examined why people are refunding, right? So like, what are the reasons that these chargebacks are happening? Why are people refunding at such a high clip, right? And we found that some of the subscriptions that they were offering, some of the opt-in strategies that they were doing were a little bit aggressive. I shouldn't say a little bit, a lot aggressive. So we pulled back on those to make it a little bit more explicit on when a customer is opting into a subscription, so they just don't receive a box of merchandise 30 days later and have no idea what's going on. The other piece of it too was bundling. So they had a lot of things that they were bundling together in addition to the subscription. So unbundling things, buy 3, get 3 free, changing the strategies and how they're bundling and making sure that the customers are fully aware of these things. So these will start to cool everything down. So once the funds are unlocked, they're not going to go back to where they just were and having the funds blocked again. You have to take the tools and all the strategies that we're discussing and actually apply them. Because again, like Isadora was saying, a lot of people come to us and they just say, I just want my funds out. Well, that's great, but we don't want you coming back to us in 6 months and then having the same exact issue. And we've had merchants do this, right? They get the funds out, we kind of tell them everything they need to do, and then if they don't execute and actually take and apply what we're telling them, you're gonna get back in the same position again. So you gotta run the business. You can be aggressive, there's no problem with being aggressive, but you also need to make sure that you're looking at it from the payment processor side, because you're just gonna keep going through a cycle and it'll just keep repeating itself. So, operationally, they've been able to execute and really implement some of the things that we've been discussing.
Yeah, absolutely. That's really good insight. And when we're looking at e-commerce, right? A lot of these guys are the ones that we get. They're in the scaling process, so maybe they're doing one product right now, and then they want to move to the next product. So first we spoke about KYB, right? Operationally, legally, and now we're looking at what kind of products. The name of the game I see in e-com is that do a lot of products, scale, and go global, right? But the ones that I have met that are doing it correctly, they have picked products that are they're good products to sell, but they're also kind of safe, maybe risky. So, Mike, what are you seeing as far as flags that might trigger funding holds? What are the maybe 2 or 3 products that merchants are starting to sell that you see they have more holds with?
Yeah. So, it kind of depends. There's 2 different sides of the equation here. So if somebody's just starting off, I see this a lot. They're going to start off with like 100 pieces of apparel or clothing, right, as an example, or 200 pieces of clothing. And I look at it and it's a very junior operator. Maybe they're, mid-20s, and maybe they have a business partner and they're selling Chinese dropship clothing to women in Italy. So, but they're advertising it like it's like the best thing since sliced bread. The product quality is great, but they're selling women's clothing that they've never tried on, right? So that to me is an ultimate red flag whenever somebody is a junior operator and selling hundreds of pieces of apparel, because you haven't touched it, you haven't put it on, you don't know how it fits, you haven't had women give you good feedback on these things. So that is like a recipe for blowing up. There is groups out there that do this successfully, and they've done it for a long period of time where they're cycling through different stores. A little bit different, right? Because they kind of hit it when drop shipping and that type of apparel model was very, just from a monetary perspective, they were able to scale that very quickly, but it's very difficult to do right now. If you're looking at it from like a single product perspective, anything like Nutra, anything that's going to give you like a guarantee, medical, any type of like medically related like device saying put a knee brace on, it's going to help repair your knee, and you have a doctor there like sitting next to the brace and they're saying that this is going to cure for cancer or cure for your chronic fatigue or issues with your leg or whatever it may be. Those are always, always, always going to get scrutinized, right? Just because anything health, medically related, those are just going to have problems, along with anything where you're giving like some type of like warranty, beauty products, 90-day money back guarantee. I've seen some at 180-day money back guarantee. You try it, and then, let's say it's something where it helps your hair grow thicker, right? I've seen this before. And you have this 4-month refund window where you're going to give them 100% refund if it doesn't work, right? So everything is just exposure, basically. If you look at it, like whenever you're warrantying, you're guaranteeing things, you're just basically just opening up the exposure window for chargebacks or refunds, right? And the simple math of this is like most businesses less than 2 years, most fail. Like, let's be honest, 90% of it's more than that. 90% of businesses less than 2 years fail. It's even tougher in the drop shipping space if you're doing that, or even branded. So if you look at it, if you're providing this massive exposure window, right? And let's say, you have a 4-month exposure window, but in 60 days you go under. Okay, well that payment processor, if they're not holding the reserves, is holding the bag, right? So you'll start to see this where a lot of people that have liquidity issues, or they just don't have a lot of money, they're trying to make the next sale to get to the next, to just get a little bit more cash, right? That's trouble, right? So you got to have, really healthy focus on like one singular product, and then in my mind, you expand from there. You got to have product market fit. It's too much of a gamble when you're trying to go super, super wide and just very macro level. You got to go very like focused and narrow, and like really niche down on your story, your brand, what you're trying to do. And you could have a few products, don't get me wrong, but you shouldn't be selling, 3 products across the entire world. Like you need to have a market, because every market's going to respond differently. The German market is massively different than the US market, than the market in Mexico and Canada and Italy, in Dubai. Everyone's going to react to your product differently, and you can't just market in one singular way and hope that's going to work. It's just not going to work.
Yeah, exactly. And so a merchant, they've now chosen the right product. So you have legal, you have operational, and now you have product. That's all perfect and set. But what we also see is processing strategy. So a lot of times these guys are trying to have multiple processors, which we see is not just smart, it's essential, right? Having like a payment orchestration platform, spreading it all across. But, and Mike, this question will be for you, where do we see the legal risk of processing the same traffic through multiple accounts, maybe the wrong way? So having multiple mids that are just built the wrong way. And is it really essential
Yeah.
for a merchant to have multiple payment processors or backup processors?
Yeah, I mean, it really depends. I think where most people get in trouble is, where's your entity located and where's your customer located, right? The most optimal payment processing structure is you are routing your transactions where your customer is located. So if I'm in the US and I have a US-based business, most of my customers should be US customers. That's going to give you the fastest, best processing in terms of rates, best authorization rates, currency, and payment methods. You're going to be able to really unlock everything. Now, if I'm in the US and I'm selling 100% to Europe, that is a recipe for disaster, because the US-based processor will likely shut you down. There'll be flags risen. You're going to be presenting in USD to a European customer where they pay in euro. So, the need for like a multiple entity structure or multiple processors is very fundamental. So you need to be looking at, okay, where's my parent entity, and then where's my sub entity, and like, I guess let me take a step back. The question is, where's your entity and where's your customer at, right? If those don't match up, that's going to be a problem.
Yeah, especially
right?
Hong Kong structures.
Yeah.
Yeah, we see this a lot in Hong Kong. I mean, yes, you can go set up in Hong Kong a tax haven, and you almost have to put it back to them. You're going to lose 20 to 30% of your traffic from failed payments in Hong Kong selling to Europe. So yes, you're not paying taxes, I guess. There's a better tax stance, but if you lose 20% or 30% of your sales, then it's kind of all for nothing anyways. You're just basically moving the money around. And then you can't unlock stability in payment methods, and you're paying like 7 or 8%. So it's like, you'd rather have it in Europe and just sell locally, because you're gonna get Ideal, Bank Contact, you're gonna have local Klarna, you're gonna have everything locally. So it's kind of an odd scenario when people go to Hong Kong, because I'm like, well, you don't really need to, because you can just set it up in Europe and you just have it. And they're like, well, the tax. And I'm like, yeah, but this is what your performance is gonna look like. So there is that too. So for me, if you're looking at optimal payment processing performance, it's local to your customers, right? The entity needs to be local to your customers. And if not, you can use like a merchant of record, or set up a sub entity and route transactions that way, which would create a multiple processing structure.
Mm-hmm.
Yeah, well, that's
Absolutely.
funny, because this is what I tell merchants every time. And my first actually thought is, I always try to imagine myself as a risk analyst at Stripe, and I get like a merchant with a company in Hong Kong selling trousers in Italy. Then my question is, why would a Hong Kong company sell trousers in Italy? And then immediately,
Mm-hmm.
boom, funds on hold. I think at some point it doesn't even take to be qualified to going through data of merchants. As soon as they see that the KYC is actually not aligned with the standard practices, funds might be on hold. And then you have to get like a second review from another human being, those payment processors, and then you need to explain yourself why you did so. But the reason lies with the problem that those people are in the game for a short time and for quick money.
Mm-hmm.
And if you are for quick money, you just are looking for the fastest way to get a few bucks to show off, instead of trying to play long term and make money as a real entrepreneur. But that's about how you want to play in the game. So don't want to question that, but most times it's about the mindset that you have and how you want to build yourself as a person.
Yep.
Yep, absolutely. Well, this was very informative. I actually learned a lot as well. Thank you, Mike, for speaking on the
Mm-hmm.
operational side, and Isidoro on the legal side. I want to close this out with a fire question. So, rapid fire, I'll ask each of you top three. So, Mike, operationally, ecom, product, anything like that, top three of what a merchant can do now to avoid funding holds. And then Isidoro, for you, on the legal side, top three. So, Mike, top three, what can a merchant, whether they are starting out, scaling, or established, do to mitigate the risk of funding holes?
Yeah, clean information. I can't stress that enough. Make sure that everything fulfills KYC and KYB information. Make sure you're providing like good forecasting, supplier agreements. Make sure everything is like operationally sound, I would say, just financially speaking and like legally speaking. It's like building a foundation to a house. You pour the cement to the house. It's not sexy. It's not the most attractive thing. But if you don't have a good foundation to the house, you can have the most beautiful house in the world, but the house will come crashing down. So that's number one. Number two, I think, look at your products and what you're selling and really, really understand your products fundamentally. You can move fast, but you also have to be patient and thoughtful in your approach when you are selling online. And I think good product quality, ensuring that everything is serviced the right way, is going to mitigate refunds, chargebacks, things of that nature. I think the other thing too is just making sure that you're implementing like customer service, like friendly, or I shouldn't say customer service, customer friendly policies, which again goes to like kind of the chargeback alerts, making sure you're implementing the right tools. And the path of least resistance is like just refund the customer, right? Like just give the customer what they want, make them happy. That's going to attribute like to better online reviews, things of that nature. So, really kind of the unsexy stuff, I guess, would be, again, operations, like clean data, clean legal information, making sure product's good, moving slower, I would say, making sure you're really focused, and then just having those operational controls.
Yeah, that's really insightful. Really good answers. And Isidoro, top three legal side of this. What should a merchant and
Well,
any
yeah.
aspect do?
Well, my top three would be before selling your items or services, run an IP research. Make sure you're not infringing on third parties' rights. Otherwise, you're going to be devoured by claim summons coming from other companies. Might be for trademarks, design patents, copyright. Second would be have clear policies like terms and conditions of your website under previously lost to. Third would be to not use nominees, which might result in money laundering. Try always to align the business structure to your location, just like Mike said before. If you are a US business trying to sell to US consumers, if you are in Europe, if you have interest in Europe, try to listen to your clients and align your target audience with your company. That would actually save you troubles when explaining to your service providers how you want to build up a bridge of trust between yourself and the payment provider itself. So those would be my top three.
Those are great answers. Well, thank you guys for joining the podcast, and thank you as well for watching our Competence podcast.